it isn't easy to launch a stablecoin. We've seen a lot of people launch stablecoins, and it's hard for them to get to scale because there is an embedded network effect. And so you have to think long and hard about whether you want to do it yourself, or could you potentially use somebody else's, or potentially do something that, well, looks like a community coin, which is something we just launched last week.
This episode is brought to you by Uphold, which is one of the top crypto platforms in the industry. I've been a user of Uphold since 2018. They make it easy to buy, sell, and trade crypto. They have 300 plus cryptocurrencies on their platform, which includes Bitcoin and all the top altcoins. And folks, they do not commingle. They do not lend out your funds. They are 100% reserved, and you can review their transparency report. And they have a lot of great features that make it easy to execute your trades. They also have a great new product called USD interest accounts, which allows you to park your dry powder or your crypto profits and earn up to 4.9% APY. Now, the 4.9% APY is only on balances over $1,000. Below $1,000, it's 2%. But what's great about this product, guys, is there's no lockups, there's no monthly fees, there's no subscriptions, and best of all, it is FDIC insured just like a bank. So if you'd like to learn more about Uphold, visit the link in the description. Welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and my guest today is Charles Cascarilla, who's the CEO and co-founder at Paxos. Charles, welcome back. Good to see you.
Great to be here. Thanks for having me.
Charles, the last time we spoke, as we were talking before the recording, was in 2022. Very different environment, definitely a different time in the market, right? But it seems brighter days are here and ahead of us. Are you surprised by the growth this asset class and industry has seen with ETFs? The stablecoin market is booming and much more.
Well, I mean, things have changed dramatically in the last 6 or 8 months. And I think what really kicked that off was the Bitcoin IPO, which is the ETF launching or ETFs launching. And that really, I think, set the stage for Bitcoin to become a traditional asset that could be held by institutions. And it kind of broke things open to a point where it'd be very hard to unwind at least Bitcoin. But now we also have Bitcoin ETFs and ETH ETFs that will be coming. And of course, we've now had a change in administration, and this incoming administration is very receptive to crypto and has taken a lot of at least campaign positions that are very pro the industry. And so from the Bitcoin ETF through to a bottoming out of prices and move forward now to all-time highs. Lots of exciting projects. Stablecoins continue to gain traction all the way through to now with the campaign. There's just been a series of positive events that is really changing the backdrop and landscape for crypto, for businesses in crypto, and I think for the operating environment now in the United States.
So, Charles, Paxos has been a leader in blockchain infrastructure and helping companies to launch stablecoins and much more. But since, I would say, 2022 or even 2023, we've seen a lot of players enter the stablecoin market. Ripple's going to be around the corner. Van Eck launched a stablecoin. There's just a lot of different folks working on different things. Is stablecoin, if not the, I wouldn't say the only, but is it the killer app of blockchain and crypto at the moment?
Yes. The short answer is yes. The reality is everybody wants a dollar. The dollar is a killer product for payments and store value, for the average person store value, I should say. Of course, it depreciates over time, and that's why people own gold or want to own Bitcoin. But for the average person anywhere in the world, the dollar is a much better currency than the one that they're using. And I think what's exciting about stablecoins is we're going from solving the use case for crypto native people, where you need a payment asset that moves 24/7 instantaneously, to solving payment use cases for the general society, where they need dollars, where they need it to move 24/7, where they need to move instantaneously, they need to move cheaply, they need to move programmably. And stablecoins, to me, really are that killer app. It's used every single day. It's used in wholesale. It's used in retail. It's been used in 80% of FX transactions. The dollar's on one side, of the transaction. So it's really the lingua franca, if you will, of the financial system. And so having stablecoins begin to move from crypto use cases to everyday use cases, to remittances, to payments, to people who are living in countries where you can't get dollar bank accounts is a tremendous innovation. And you're just at the very beginning because you're talking about not just hundreds of billions, but you're really talking about tens of trillions of dollars if you look forward 5 or 10 years. It's hard to imagine a world where stablecoin is not the mechanism for any fiat currency to move. Now, maybe that would be stablecoins as we understand them today. It could be CBDCs. It could be something completely different. But it's going to be an open system for moving payments because nobody wants the financial system that's stuck on the intranet.
Yeah.
They want a financial system that's operating on the internet. And that's what blockchain enables is a safe, secure financial system operating in an open way like the internet. And that is a real game changer. And stablecoins are the mechanism to create that change.
Absolutely. And Charles, I'm sure you've seen and heard about this, but it seems there's more dialogue in DC now as to the importance of a US dollar-backed stablecoin or stablecoins in preserving the world reserve currency status, which is the US dollar. What do you think about those conversations that are, kind of unfolding now?
I think it's very important. I think it's an important recognition that stablecoin holders have more US dollar debt than, say, Saudi Arabia. I mean, that's an enormous statement. It's up, I think, maybe 16 or 17 now in terms of largest holders would be stablecoin if you took them as one holistic group. And I think that's important because the US is issuing a lot of debt and it needs holders of that debt. And central banks generally around the world are selling US debt. But central bank selling is not an indication of the demand for US dollars. Retail and even wholesale, there is more demand than ever for US dollars. The average person wants dollars, they can't get it. And the reason is the traditional banking system is operating like the post office. It takes days and days and days for dollars to move, and it's high fees, and that doesn't make any sense because all electronic dollars sit in a bank. We're not trying to move around physical cash. Why is it taking as long as a physical movement mechanism like the post office? But it is. And really, blockchain is now enabling your money to move at the speed of the internet, just like anything else. Now, don't get me wrong, money is valuable and is regulated. And so you have to have an overlay that's put into place. But fundamentally, it's just like moving an email. Right. And you can put the right structures in place so that it can move like an email, yet have other protections. And the way the banking system and the payment system is operating today, that's not the case. And we put certain abstractions in place. But generally, if you want to move money overseas, it's many days. And if you want to move money between someone who doesn't have a bank account and you're going to pay big fees because there's remittances and last miles. The way it works today is anybody with a smartphone can now have a wallet. And the fascinating thing is in 15 years, the penetration rate of smartphones is 85% of the world's population. Meanwhile, underbanked and unbanked people still represent about somewhere around 35 to 40% of the world's population. So the penetration rate of smartphones is now higher than people getting adequate banking services. And banking's been around for centuries. Right. And it just shows you the distribution mechanism for US dollars has not kept up with the demand. People want the product in a different way. And by the way, if the US dollar doesn't provide that, people are going to have to go get it somewhere else because the demand is so much. That's where people might use digitized gold, or they'll use Bitcoin, or they could use a CBDC from China or some other country. People need a payment mechanism that can solve the problems in their daily lives. And the way the dollar is operating today, it doesn't do that. But stablecoins offer the capacity for the dollar to do that. And that's really positive for the dollar in general. You have to have distribution for a great product. Otherwise, you're going to fall behind and you're going to face an innovator's dilemma and someone's going to come in and they're going to disrupt you.
Yeah, absolutely. Well put. And, we're headed to a more digital world, not a less digital world. And to your point, smartphone penetration, I've seen people in developing countries that have smartphone. They don't even have a computer, but they have a smartphone. And the way people transact now, it's digital payments. They want fast, cheap, easy to use. And obviously there's a demand for the world reserve currency. So you're spot on there. What are your thoughts on stablecoin legislation that is being worked on here in the United States? We saw the EU pass a version that kind of disrupted a bit of what Tether was doing there and their positioning in the EU. What are your thoughts on all of that?
Well, the U.S. has a number of different bills on the stablecoin side, some in the Senate, and one that has passed through the House Financial Services Committee. And that one is something that we very strongly support. And it creates a clear state pathway for firms to issue stablecoins. The reason I think that is so important is because fundamentally, stablecoins are really not risky and they're really not all that scary. There are $6.6 trillion of money market funds.
Mm.
There's also $6.3 trillion of banking assets that doesn't even go to a Federal Reserve regulated institution. So you have $13 trillion of either money market funds or banking assets that doesn't have Federal Reserve oversight. And yet everything is fine. And stablecoins are safer than money market funds, at least when you issue them like Paxos does through a trust company or a ring-fenced issuer like we do in both Abu Dhabi and Singapore. That means if anything happens to Paxos, your assets get returned to you immediately. They are separate from our operating business. They are held in client name, bankruptcy protected. Something happens, you get it returned. And that's safer than any other type of financial asset. And so it's safer than a money market fund as it exists today. And it's certainly safer than having money in the bank where you only are protected up to your FDIC insurance limit. Right. So there's $13 trillion and they're not overseen by the Fed. We don't think that stablecoins need to be overseen by the Fed. They just need to make sure that you have a clear set of frameworks that everyone has to follow, like Singapore has done, like Abu Dhabi has done, like New York has done. Because buying T-bills and putting them in a vault is about the safest thing in the world. And then taking those T-bills and creating a stable coin on a blockchain is also really very simple to do, especially if you have an oversight from a regulator and if you're following the right reserve requirements, all the things you need to do. Now, Europe has codified legislation as well, as you pointed out, and that's something that we're also going to comply with. What's unique about Paxos is that we have a primary regulator that oversees each one of our stablecoins in New York, in Singapore, and Abu Dhabi. And that's not true for either Circle or Tether. I'm not saying that there's something wrong with their product. It's just that they don't have a regulator. They don't have a regulator that oversees the issuance. So that makes it a little bit trickier when you're trying to comply with different jurisdictions' rules because you got to follow the rules of your home regulator, and then you also want to follow the rules of a regulator in the market that you're operating in. And so we're working on that. I think it's good to have a set of rules. I think certain ones we're more supportive of than others, but from the very beginning, we've been regulated. We first got a New York trust all the way back in May of 2015, the first trust in the whole country that was approved to operate in crypto and blockchain. So we've clearly asked for permission, not for forgiveness. And we've not just done that in the US, but around the world. And so we're all for it. But, not all regulation is created equal. Not all regulation promotes a healthy functioning market. And that's what we want to make sure exists.
Talk to us a bit about the issuance process and what the regulators want to see. Is it KYC, AML, also that you have the respective reserves and there's a one-to-one correlation, so to speak?
I think those are the key outlines. They also want to make sure you have the right operational procedures. So what are in your reserves? How are you making sure that those reserves equal the number of tokens? So it's a one-to-one backed and backed by what? And backed where, what jurisdiction is it held in, and then when you have customers using the product, who are those customers and what are they using it for? And these are the key components. And then how do you make sure that operationally you can handle different types of risks that might arise, whether for redemptions or creations, for hot minting and cold minting, et cetera. So there's a whole number of things that you have to do for what seems like a relatively simple product. And of course, you need to make sure that you're monitoring your asset is maintaining its peg even out in the broader ecosystem. And so that's a whole process. It takes a lot of sophistication to do it right. We've done it more than anybody. We've now issued 6 different regulated stablecoins of different kinds, and we've even tokenized U.S. equities in the past. So we've done so much to build a lot of credibility around how to do this. And I think that's part of the reason why we're able to go in and really have a good influence on the policymaking process. But all regulators are concerned with some version of, reserves, issuance, customers.
Earlier you mentioned that this stablecoin, the market doesn't necessarily need to have Federal Reserve oversight. But do you think here in the United States that because there's so much control of the currency and the world being the world reserve currency as well, that they may want to plug in to your infrastructure or even the different blockchains to monitor this so they know where the currency is going, how it's moving around the world, and so forth? Once again, from the government's point of view, I don't personally agree with it, but I'm thinking about the Treasury and Janet Yellen and these folks, right? Maybe part of the problem why they were trying to slow down crypto through regulators is they have a blind spot. They don't know where the currency is going.
Yeah, well, look, ultimately, the U.S. government is the issuer of dollars. And it makes sense that they want to know where their dollars are being used. Yeah. It's a liability of the U.S. government and of taxpayers. And so, there's pros and cons around the government being able to see where payments are and what they're doing. That's a different debate from us as an issuer, and not necessarily, one that is something that we should even be weighing in on. And so we'll follow the right rules around what should the government know, how do you share information, how can they see information in aggregate, and we'd of course be happy to make that available if that's what is required. And I think having information sharing is totally fine. I think there are things the Fed could do, like for instance, allowing issuing firms to have master accounts at the Fed, which would be like the equivalent of having a bank account, but having a bank account at the Fed. But you just can't go into debit, meaning we can't be borrowing from the Fed, but you could have a bank account there. And there are other countries that have done that for non-bank payment service providers. It's a mouthful, but for instance, the Bank of England has done that, where Revolut has an account there. Yeah. And you could do that, and the Fed could see then all of the reserves because they'd be sitting in their own bank account against what you're issuing. And it'd be very simple for them to make sure that you're maintaining the peg. Your liquidity would be perfect. Your maturity profile would be exactly perfect, but at the end of the day, if a stablecoin issuer like ourselves, and for instance, we had a stablecoin that had $25 billion outstanding at its peak, and we were able to redeem $6 billion in one day, or $5 billion in one day. So you run the right profile, you can manage this. It's not all that complex. You own T-bills or overnight repo, over collateralized by treasuries, and you have an issuance, and people can see what it is. We publish down to the QSIP number. You can literally see the exact security that we own. We publish that monthly. It could be done more frequently. I don't know if that's necessarily practical, but anyways, this can be extremely transparent. And of course, it's on a blockchain, so that's all public as well. So there's just a lot of logic to stablecoins, and I think another thing to really impress upon listeners here is the stablecoin market is clearly gaining product traction, but it's also clearly very early. What chain is going to scale to societal-wide level? Yeah. Nobody knows. None could right now. So nobody really knows. What could you want to use an L1 or an L2? Do you create netting layers? How are you going to move trillions and trillions and trillions of dollars in transactions every single day? I don't think we have the right answer for that yet, but I can tell you the private market is going to iterate and figure that out and feel the need to solve customer problems much better than a mature organization that has historically not innovated at the speed with which the market is moving. And that's why you need the private sector. That's why you need stablecoin issuers, but why you also want to have a regulatory framework that creates a set of rules but doesn't stifle innovation.
Absolutely. Now you mentioned, the different L1s and so forth. Last time we spoke, I know you guys were primarily using Ethereum as your L1 to issue these stable coins. Have you expanded to other blockchains like Solana and so forth?
We have expanded to Solana, Arbitrum. We're working on a Stellar and Polygon. There's a whole number of chains that we're going to be issuing on over the next 6 and 12 months. There's always a tension between issuing on another chain versus making sure that there's enough activity on that chain to warrant all the controls that you need to put into place. And again, because we're regulated, we go to our regulators and we talk to them about the chain. We get it approved as an issuance mechanism. And that's different from a regulator allowing someone to own the token of the chain. This is about enabling issuance onto a chain. And I do think that, it should probably be a little bit easier to issue regulated dollars on more chains. We just saw BIDL get issued on a whole number of different chains as an example. And I think that makes sense. Tether and Circle are on all kinds of chains. But again, they don't have a regulator that they have to go to in order to get approval. We do. And so that is oftentimes really the gating factor for us, making sure that all of the investment we have to make in order to issue is commensurate with the amount of activity that we're going to see. But I do think that there's so many different chains that people are on and experimenting with and using cross-chain swaps. And there's tailorization that's happening for stablecoins and stablecoins that are then being wrapped into other types of stablecoins. It's just proliferating at an enormous rate because you're able to customize. And, people customize their credit cards in a million different ways. What do they look like? What's going on? Why wouldn't they want to customize on their own chain? And they do.
Now, you guys helped PayPal to launch PYUSD. How did that relationship come about, and how did you end up getting the execution of this going?
Well, PYUSD is something that's very exciting for us as the issuer. And that means in the background, we are running the compliance, we're running the reserves, we're running the technology, we're running the operational procedures. But it has PayPal's name on it, and they are the distribution partner with their name. This is their asset. They can go distribute it as they would like. This is very similar to how white label credit cards work. There are so many institutions that have credit cards. Almost none of them do it in the background. They utilize other services like Alliance Data Systems or Citigroup or whatever. You may have even heard of some of these companies, probably. And yet they exist and they provide this white label service. And that's what we've done here. We have done other white labels in the past, Binance and others. And to me, this is a really interesting strategy for a company that has a big system. Certainly PayPal is amongst the biggest systems because they have consumer wallets, both on the PayPal and the Venmo side. And then they have merchants that they solve transaction processing for. And they do that through Braintree and paying to PayPal and otherwise. And so they have both sides. And some of the biggest costs for them is their network costs. And if they can get their customers to be able to pay merchants directly in stablecoin, you change your cost curve substantially. And now PayPal ultimately has their own strategy for how they want to handle this. But I think, clearly it's indicative that stablecoins have an important place in the payment ecosystem for someone like PayPal to decide to adopt. Now, they've been a first mover. They offered crypto to their customers years ago, coming out of the last bear market, and then they launched PYUSD during this past bear market, both times essentially marking the bottom. So they've done some really great innovative things in the crypto ecosystem, recognizing how this is going to be the future, and it will change cost curves, delivery mechanisms, the way in which customers have a daily interaction, and in a very important way. And they're not the only one. We have these conversations with companies almost every day. Would you want to do a stable coin? Would you not want to do a stable coin? And that's a tricky thing because it isn't easy to launch a stablecoin. We've seen a lot of people launch stablecoins, and it's hard for them to get to scale because there is an embedded network effect. And so you have to think long and hard about whether you want to do it yourself or could you potentially use somebody else's or potentially do something that, well, looks like a community coin, which is something we just launched last week.
Yeah, so on that note, is that the global dollar stablecoin news where it's backed by Robinhood, Kraken Exchange, and some other folks like Galaxy Digital?
Exactly. And so the way we've set that community coin up is that there are two elements. One is that you have the actual regulated token, USDG, issued out of Singapore. It's a dollar stable coin. It's issued by a ring-fenced entity. So the entity doesn't do anything aside from issue. And it holds dollars and T-bills and overnight repo. So extremely secure, one-to-one backed. And it's a traditional dollar stable coin that is prudentially regulated by a primary regulator, which is the Monetary Authority of Singapore. And we earn a fee as the issuer, an asset management fee. And so that's the token. Then there is the network, which we're calling the Global Dollar Network. And that's actually open for any institution or company to join. So anybody can join. The launch partners were Robinhood and Anchorage, Kraken, Galaxy, Bullish, Nuvei. If you notice, there are fintech firms, there are payment companies, there are exchanges, there are custodians. Anybody can join. And the concept here is if you're a member of the network, almost all of the interest that we earn on our reserves is returned to the network members. And that's based on assets under custody, as well as net minting, as well as accepting the stablecoin. And so people can earn interest in rewards by any of these different activities. And you're not just limited to one thing of holding balances. It could be that you're growing the usage of the network by doing a lot of net minting or by receiving the stablecoin in as a payment mechanism. And so we also reward that as well. But again, anybody can join. So it's an open network. All of the economics are returned to the network itself. We are simply the issuer. We're also a member of the network, but they're separate, and it's meant to be separate.
So what would be the benefits of this network? If I'm let's say I'm Microsoft, right? Versus launching my own stablecoin versus joining this network, is it kind of Metcalfe's law? It becomes stronger. There's more trust, and having more institutions. There's more eyeballs on this, and maybe I get a larger network effect.
Well, there's generally, I think, two 0 to 1 problems that anyone faces when they launch a stablecoin. The first 0 to 1 is, can you get your internal system to be able to recognize and use your new asset that you just created and embed it really well within your systems? And then can you also go out into the broader world and get it embedded and used on a broader basis? And what we found is that those two problems are complex to solve, even for very sophisticated institutions. And if you're smaller, it might be easier for you to solve your own network problem, but harder to solve the external network problem. If you're bigger, you have more weight, but your internal network problem is quite significant, and getting the external one is still meaningful. And that's the whole point of the Global Dollar Network is everyone is working together. The network is an open network, so everyone can come in. And so you, of course, might still want to have your own stablecoin.
Sure.
And this is not exclusive. You can still use other stablecoins. But the point here is that everyone is being rewarded collectively. And as the network grows, that collective pool gets bigger and bigger as it gets allocated. So you're getting, I think, from everything that we see, actually better economics by being part of a network like this than you would if you just ran your own. That's not necessarily always going to be the case, but I think that's generally the case. And that's why a lot of these institutions join. I think that they looked and they thought about what does it make the most sense for their businesses. And these are still very significant, size institutions. And for them, being part of this network was, I think, their answer.
Yeah, absolutely. Is there a cap to the number of participants that can go on this network, or it's, unlimited to a certain
It's
degree?
unlimited, and everyone has the same terms. So that's the great thing about it. You join. If you do a lot of activity, you can make more than someone who does a little bit of activity. And anybody can come on board. And so there are different tiers for activity, but everyone has the same term. The whole point was this isn't about somebody owning it. It's about the users getting the return from the work that they put in and from the usage that they do.
Why Singapore and not the US?
Well, Singapore is someplace that has put together a framework where it makes a lot of sense and it's very easy to do. This is something that's a global asset that's used globally. Singapore is a global financial hub. The reality is the U.S. hasn't put into place a stablecoin framework yet. And so, we're trying to really think innovatively about, where can we operate that will create the largest pool of potential users, because ultimately this is a global business. Stablecoins are a global asset. And, I think there is a really important place for the US to play in this. But we need regulatory certainty, regulatory clarity, regulatory consistency to be able to invest, not for just the next 6 months, but the next year, the next 5 years, more importantly, the next 10 years. This is something we're going to do for decades. And so when you think in those types of time frames, it was hard to do that in the United States where we just don't have that.
Yeah, absolutely makes sense. But I love this idea, Charles. Like, would I feel more comfortable using a stablecoin where all these participants, well-known names, like Robinhood? I use Robinhood. I've used Kraken. I know about Galaxy Digital, Mike Novogratz, and so forth. Having these folks backing the network and monitoring, so to speak, would I feel more comfortable? Absolutely. Versus one institution stablecoin, which may have been launched, sooner, or I should say recently. So I love this idea.
Well, and also what's really important is because it has a primary regulator, if something happens to us, your assets get returned to you, they're your assets.
Mm.
Every other stablecoin issuer, and there are, I guess, some who launch out of trust, but of the major ones, you are a creditor of an issuing entity.
Mm.
You're not the owner of the asset. You are lending money to these institutions. And of course, that doesn't mean that they can't pay you back. But if something that was ever to go wrong, it could take you a long time before you get paid back.
Right.
In this case, it is set up where we have a ring-fenced entity. The money can be returned to you. It's creating regulatory certainty. It's creating financial certainty. It's creating also, I know this is sometimes a little obscure, but it's creating accounting certainty. What exactly is it that you have? And all of those things come together to create a trusted stablecoin that can scale to what I think is societal-wide levels. We're not just thinking, how can this work at 1 billion or 10 billion, but how does this work at trillions?
Absolutely. Now, I read that this is launching on Ethereum. I'm assuming the plan is to have it go to other chains as well eventually.
Exactly. The first place we launched was Ethereum. We're ready to start rolling this out on other chains. We've already issued our other stablecoins on other chains. So it's just a question of sequencing.
I have a question. This may seem like a weird question, but I'm very curious about it. I think you touched on it. How do stablecoin issuers like a PayPal or a USD, how do they make money? Is it interest on the reserves, the T-bills, and also fees on the transaction fees on the blockchain?
Yeah, I think there's a couple ways you could earn it. Not every single one does the same. In our case, we are earning an asset management fee. So we are managing the reserves. We're taking an asset management fee. You could, instead of earning an asset management fee, just earn all of the interest on the reserves. And so you earn the interest. You're not taking a fee per se. You're just keeping the interest. Another mechanism could be certain types of transaction fees. We don't happen to take any, but for instance, you could charge a redemption fee. So you come to redeem and get something, and there's issuers then that are charging 5 or 10 basis point redemption fee. You could also charge a minting fee. You could charge certain transaction fees. So that you're doing. You could charge not necessarily even for any type of issuance, and you're just charging it on infrastructure that you're providing, API calls. So there are different mechanisms that you could do. I think what we try to do is think about, where is the puck going? How do you run towards where you think the ball will be? And I think it's hard to imagine from a historical analogy standpoint an issuer keeping all of the interest. It just doesn't make any sense. To me, the whole point of stablecoins is that you democratize access to the dollar. Very powerful, very useful. But once you democratize access to the dollar, it's almost immediately after that the question becomes, how do you democratize access to the risk-free rate? How can you make it so that anybody can get the risk-free rate? Because frankly, everybody should be able to get the risk-free rate. Why shouldn't everybody be able to get the same return on T-bills that an institution can get? Now, you can if you go to a money market fund, but not if you're keeping your money in something that's transaction enabled. Today, if you kept your money in a bank, you're getting 0 to 2% interest. The wholesale rate is, let's say, 5%. In what world does the retail wholesale spread exist at that wide of a level? You know, you're talking about 60, 70, 80, 100% difference between retail wholesale. That is completely anachronistic. And it doesn't make any sense, because putting your money in a bank is not risk-free. You have risk by putting money in a bank. Whereas with a stablecoin, you have no risk. The risk is the T-bills that are being held in trust. It's very, very tiny in the grand scheme of things. It's less risky than a bank and less risky than a money market fund. So you have basically the safest dollar in the world paying you potentially the highest return. That's where the financial system needs to go. That's where it should be for everybody. I can get dollars and I can get the risk-free rate. And you can completely change the financial system and people's lives, their financial lives, all over the world. That's why everybody wants a dollar. They don't want a peso that's devaluing. They don't want any other fiat currency where you have potential political instability. They want dollars, but they want to also be able to get interest on it. And we have a mechanism for that, and that is actually really good for the U.S. government to be able to issue. Maybe it's too good, because then we can run even bigger deficits. So that's not necessarily positive, but it's still fundamentally what you want as the reserve currency.
Yeah, that absolutely makes sense. Charles, I know we're running up on time, so I want to ask you about your outlook for 2025. We got a pro-crypto president. We got a pro-crypto Congress coming in, and there's bills being worked on in the House and Senate and so forth. Are you optimistic that we see, a crypto boom in 2025 and going into the further years?
We're going to have a crypto golden age, in my opinion. This is going to be unbelievable. I hope we don't overdo it as an industry, but this is going to be phenomenal in terms of how it opens things up. And the U.S. has been lagging behind, but it hasn't, and by any means, completely fallen behind to the point where it can't recover. And the U.S. puts the right type of incentives in place, and companies like ourselves, where we've been moving jobs overseas, will not necessarily move the jobs back, but will invest so much more in the U.S. And I think that is an exciting opportunity for the whole industry, for the United States. I think the key thing here is not just having a pro-crypto president and a pro-crypto Congress, but having pro-crypto regulators. And of course, because you have a pro-crypto Congress and pro-crypto administration, you'll end up with pro-crypto regulators, but it takes time. And that means that it's not going to be a light switch. There are certain things like, say, SAB 121, some accounting rules, or Operation Choke Point 2.0 that you can try and you can just reel that back in. Some things might require legislation. I think that means you're going to be looking probably at the end of 2025, maybe even beginning of 2026, for getting a bunch of legislation through. But with all of these pieces in place, you can really open up the floodgates of opportunity, of projects, of innovation that has been held back really unnecessarily. Now, I think the key is just going to be making sure that we do it right. Because if you overdo it, you sow the seeds of your own demise, and that's not healthy. But, look, I would certainly take this open opportunity and this crypto golden age all day long over where we just came from over the last 2 years, which was, really a weaponization
Right.
of the regulatory apparatus against the industry in a really unjust and unfair way. And, we suffered that, but so did everybody else in some different level and degree.
Yeah, absolutely. I mean, it was so brutal, but I think the industry came together, started fighting back, taking cases to the courts, and then obviously spending in the election, and we're seeing a big change now. What's on Paxos's roadmap for the remainder of 2024 and early 2025?
Well, we've had a lot that we've done so far in this fourth quarter. And even the second half of this year, we launched our yield-bearing stablecoin out of Abu Dhabi, called USDL, Lift Dollar, that pays interest daily. We have launched this USDG in the Global Dollar Network. We've also launched our stablecoin infrastructure product. We power Stripe, and that enables someone to be able to pay with a stable coin to a merchant and be able to settle it out, which we do. And we're working on that. That's called pay-ins. We're working on other aspects of payment infrastructure here. And so we have a number of things that we're launching to really improve the user experience and to scale these products, launch on new chains, add more partners. There's a lot of scaling that we need to do. We spent all this time building into new jurisdictions and building new products, and we're going to keep launching products. But a lot of it is, how do we keep solving our customer problems as fast as you can? The only thing that makes you enduring is your ability to innovate and keep solving your customer problems, because they don't stay the same. That's the nature of the world we live in, more than any other time. Customer problems change fast, and you have to respond to that, or you're going to get left behind.
Mm. Charles, amazing. And I need to have you on very often because you guys are doing a lot of great things, innovating, working with some very big institutions and launching great products. So it's exciting stuff. And thank you so much for joining me.
It's great to be on, Tony. It's always a lot of fun talking with you. It's been too long.